Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to present the 20 stocks that I selected for my Yuh portfolio. They can change in the future, that's for sure, but for now I'm settling on those 20 stocks. And yeah, I promised this video already 3 weeks ago, so it's finally here. And how I came to these 20 stocks? Well, you know that I analyzed the stock markets from the countries here depicted in green, and with all their indexes that I analyzed, I had 270 minus 3 because in the Swiss stock market, in the first 50 companies, you have a few doubles. So Lindt and Roche, for example, they have a double quotation, and I didn't want to include both. So yeah, it's 47 stocks from Switzerland that I have selected. And in the end, 7 of those stocks are in the 20 stocks that I selected for the Yuh portfolio. From Germany, there are 6. From the Netherlands, there are 2. From France, there are 2. From Italy, 2. And from Belgium, 1. And in fact, from the Netherlands, one of the 2 is actually a firm from England. And I wanted to include a third one, but unfortunately, I have a few restrictions as well. And in my final watch list, I had 80 stocks because I included 3 others. I'm not going to name their names, but in total, I have 80 stocks that I monitor closely. And another restriction is that they need to cost less than 200 Swiss francs. So in my watch list, there are stocks that cost more. But as you know, I only invest 200 Swiss francs per month, and I want to be able to invest immediately into one of the stocks that are in my list. So unfortunately, few of the stocks on my watch list of 80 stocks, they cost more than 200 Swiss francs. For example, Louis Vuitton, yeah, costs way more. I would have to save for 4 months before I can buy one stock of Louis Vuitton. So I'm not going to do that. And another thing is the Yuh restrictions, and there is the one from the Netherlands that I wanted to include as well. There you can only invest in 64 Swiss stocks and 71 European shares. So all the other ones you can't invest in on the Yuh-platform. So that's really important that you know that. You have also a selection of the UK and the US, but I don't want to diversify further than Euro and Swiss francs. So that's why I only chose to analyze these countries. If you want, I can analyze other countries as well, even the UK, but for now I'm stopping with the stock analysis. I'm going to go back to the ETFs in the future videos. And another Yuh restriction is that you can't put in limit orders. I most of the time do it. Actually, I always do it on the Swissquote platform. Even for ETFs, I also use limit orders. So for Yuh, it's always at market that you put in the orders. And it's not really a problem because the 20 stocks that are in my list right now, they are well traded. So when I put in an order at market level, most of the time there won't be a surprise for me. So for me, that's okay. But unfortunately, one of the stocks that I wanted to include was Unilever or Unilever, and yeah, that's on the Amsterdam Stock Exchange. It's a UK company, just like Shell, because that's one of the two. And yeah, it's not available. It's only available from the UK, so that's unfortunate. But What are then the stocks that are in my selection? Well, the first one is one from Belgium, the only one from Belgium, and it's AB InBev. I really like AB InBev. They dropped their dividend a bit in the past years, but still, I think it's really attractive. They are working on their debt as well. The dividend yield is 1.35% right now. Their profit is going up. Their earnings per share is going up. And the payout ratio right now is really great. They were worse than 30%, but now around 31%. It's really great. The PE ratio is a bit high to my liking right now with 22.66, because I like to buy it around 55 and then it's around 20. And the best time was actually around the COVID period, of course, like a lot of stocks that we are going to see, but that's I'm not going to repeat that all the time. And positive points, well, AB InBev, it's a global player. It focuses on premium beers as well, and it's working on its e-commerce with Bees and Zay Delivery. And negative points, well, it really has a high debt. It's working on it, so they are reducing it. But yeah, for as long as I can remember, they have a high debt level. Of course, when you have global presence, you always have currency problems. So, but with a lot of companies, there is going to be currency problems. But I'm not always going to name it by name. You can also read the slide, of course. And it's a highly competitive business, the beverage business. So here you can always see the sector where it is in, so beverage brewers and consumer defensive. And yeah, the graph from Yahoo Finance from the past, how it performed in the past. So right now, yeah, you see from 2020 on, it was really stable. It moved up a little bit, and normally that's fine for AB InBev. When they can continue like that, it's more than reasonable. I had them in my portfolio in Belgium from 2001 till 2015 and a half, so halfway 2015 I had them in my portfolio. And yeah, then they really outperformed the Belgian market, so I was really happy about that. Then thereafter I was also happy that it declined. And when my brother-in-law asked me in 2020-21 which stock he should buy, I immediately said AB InBev. It's a decent choice. So he has that in his portfolio. The second one, it's Accor from France. Right now, 41.98. It has a dividend of 1.18, so a dividend yield of 2.81%. An earnings per share of 2.26. The payout ratio is 52.2%, so below 60%, so for me it's still okay. The PE ratio, it's 18.58, and yeah, I should have been quicker with buying Accor. So a month ago the price was much better, but yeah, it's the way it is. A lot of stocks are going up right now, so the positive points, well, it has a global presence. It's present in 110 countries. It has a strong focus on sustainability and diversification, and it has quite a few partnerships with luxury brands that they cooperate with to make their hotels more luxurious. I can't say it another way. Negative points, well, it's a travel sector, so they are economy and geopolitical sensitive. and it's a highly competitive business. So with Marriott and Hilton also being one of their competitors. But Accor definitely one that I'm looking to buy. AXA, yeah, we have all our insurances with AXA, so that's a company that I definitely want to buy. Right now, 36.08, dividend of almost 2 euros, a dividend yield of 5.50%, so that's really nice. Earnings per share of 3.23, so the payout ratio is just above 60%. The PE ratio right now 11.17, so definitely one that I'm looking to buy. Their positive points are present in over 60 countries. You wouldn't expect it, but they really have a lot of countries where they are selling insurances. They have a wide range of products. So we have all our insurances with them, only the building insurance, not of course, because that you have to take from the canton here in Switzerland. You have the solvency ratio of 227%. Okay, that's not as great as Swiss Re, but still it's above 200%, and that's what I like to see for insurance companies. Negative points, yeah, we have a lot of floods, a lot of storms lately, also in Europe. So not only in America it's happening, but luckily here hurricanes are not happening. But yeah, floods bring along a lot of costs as well, so that's not a great thing for AXA. You have a lot of problems because you are present in 60 countries, so you have to deal with all the regulations in all the different countries. And yeah, insurances, because you can make a lot of money in it, it's a highly competitive business. Then BASF, you wouldn't expect it because it's really performing badly lately, but BASF, it's a great company still. They are reorganizing right now, and I think they are doing the right things. So the dividend, it's in red, 3.40. So the dividend yield, it's definitely going to drop because they announced that they are going to cut the dividend. They are going to not going to cut the dividend, but they are going to lower the dividend. And earnings per share last year was negative. The payout ratio, I can't say then, and also the PE ratio, not of course. And the positive points, well, it's a global company. They are aiming to set up a new corporate strategy, and they are succeeding in my eyes. So, and they made the right decision to reduce the dividend to at least 2.25 euros they announced. So you immediately see that the dividend yield is going to reduce to around 4.8%, 4.80%. So still not bad at all. And from 2027, they already announced that they are going to do buybacks in the grand order of 4 billion. So in the coming 4 years, they are going to distribute 8 billion, and then in the last 2 years of the new strategy, they are going to buy back 4 billion euros in shares. So that's a great prospect actually for investors. But of course, the earnings per share are still going to suffer in 2025, but they are going to go up slowly. Maybe first they still are going to go down, but it's always the case. You never know when the final bit is there. But yeah, BASF, they are great. Negative point, they will reduce the dividend, but I look at it as more positive because it's really hard for a company that already paid out so long a rising dividend to finally decide to reduce the dividend. But they made the right decision, and that's what I want to see from a management. And yeah, Chemicals, it's also a highly competitive business, but it's going to be the case for all the stocks that I name in this list. And the next one, it's also from Germany. It's Bayer. So right now 26.38 euros, and you see it's quite big in the red. You can buy it at the level of halfway 2005, and even when you go further from 2003. So it dropped big time since 2016, and the dividend, it's only 0.11. They cut they reduced the dividend considerably as well, just like BASF is doing, but Bayer really put the axe in it. The dividend yield now is only 0.42%. The earnings per share minus 1.29, so no payout ratio to be calculated, and the PE ratio is also nowhere to be seen. The positive points for Bayer, it's a global company. It is diversified, as it is directed towards pharma and crop science right now with the takeover of Monsanto. They reduced their dividend, and as I said with BASF, I like to see that because it's always a right decision. When there isn't money for keeping up the dividend, you shouldn't do it. And then the negative point, yeah, you have the restructuring process going on. You have the Monsanto problems with all the litigations in America, and then you have a high level of debt as well that they are trying to get rid of, and that's going to take a long time. But Bayer, it's definitely on my radar, and from the moment that I believe that the story is getting more and more positive, I'm definitely going to get in Bayer. Then BKW, you already know that I invested in this company in the Yuh portfolio, so I like this one a lot. It has a dividend of 3.40 Swiss francs, so a dividend yield of 2.18%. Earnings per share of 9.49, so a really low payout ratio of 35.8%. The PE ratio is still 16.60, so nice buying opportunity there. And as you can see, yeah, the graph, it's always rising, and I think they are going to continue to do that. Maybe it's going to slow down a bit. So you have huge investments that are ahead, but they are already planning it, and they are already setting aside money to be able to pay everything. But yeah, the operational costs are going to go up, of course, and it's actually not that big of a player. It's a small player, but on the other hand, small players are also really nice to invest in because they can grow, and I hope that they aren't subject to a takeover. But because they have huge investments ahead, I don't think many companies are willing to take over BKW. So in that regards, I'm happy that it's not possible that they are going to be taken over. And I hope that when they did their investments, that they are not going to be taken over as well, because then of course we as investors, we took the hit, and then the new owner is going to run away with the future profits, and that can't happen, of course. So let's cross our fingers for that, and let's hope that the graph of BKW or BKW goes upwards like it used to do. Then we have Deutsche Post, DHL. So yeah, the price right now 38 euros around, a dividend of 1.85 euros, and a yield of almost 5%. The earnings per share are 2.74, so a little bit higher than 60% payout ratio, and a PE ratio of 13.87, so that's interesting. Still a bit high maybe for a logistic firm, but on the other hand, DHL it's a really great company. They are really reliable, and that's really important, being a reliable shipper, especially when you are in my field. Yeah, so I do in yeah, I send dangerous goods, and when you send it with DHL, you can sleep on both ears. That's not always the case when you operate with other shippers. And negative points are because you have a lot of competition, you are working with low margins. But yeah, Deutsche Post, they have a strong cash flow, and as an investor, you want to see a strong cash flow. So because then they can work with it, and yeah, DHL, really great company, one that I'm looking forward to have in my portfolio as well. Then two Italian companies. The first one, Enel. So 7.33 euros. That's a really nice price to get in with a low amount of 200 euros every 200 Swiss francs every month, because then you can buy a lot of shares. But you always have to look at other things as well, of course. And a dividend of 0.43 means that you have a dividend yield of 5.87%, and that's really nice. So the earnings per share is 0.52, which means that the payout ratio is unfortunately rather high with 82.7%, and the PE ratio is attractive right now, 14.10. And you have different positive points to the company. So they are present in 43 countries. They focus on renewable energy. Their strategic plan that they are dealing with right now, it's going according to plan, but they still have a high debt level. And yeah, they are reorganizing with sales of assets and also with other financing. So they are putting out bonds, I think, and yeah, lowering their debt with other debt. Hopefully, it's done with less interest burden. But Enel, although the PE ratio looks nice, the dividend yield looks nice, the payout ratio is too high for me, and the debt level definitely needs to come down. And then you have Eni, the other Italian company. So oil and gas integrated, and there the dividend is it's euro, of course, €1. Sorry for that. You have a dividend yield of 7%, so even higher than Enel. The earnings per share is 1.18, so the payout ratio also above 80%. So the both companies are actually quite comparable. Also, the PE ratio is on the low hand with around 12. So it's buyable, but with a payout ratio above 80%, not that attractive. And just as with Enel, you have a high debt level, 16.2 billion. They are really tackling it, so they are really lowering it with a higher rate than Enel, and I like to see that. But on the other hand, yeah, it's still something that I'm watching from a distance, just like BASF and Bayer and Enel. Then you have Holcim. Yeah, you know, I already have this one in the Yuh portfolio as well. So price right now 84.78. The dividend is 2.80 Swiss francs, or a dividend yield of 3.31%. The earnings per share is 5.33, and the payout ratio below 55%. So that's why I bought it. Of course, all the metrics are really nice. The PE ratio is also nicely below 18. You have good positive points. They have a strong market position in Europe and in the USA, and they are going to split the USA part, and they invest a lot in R&D, which is great because then you can come out with new products that can interest new potential clients. And yeah, the split, it's a positive thing, of course, but there is a lot of uncertainty because they haven't really communicated that well about the split. They announced it, and then you hear some stuff about it, and now apparently the rumors are that the USA part is also going to note on the Swiss stock market, which is great for ETFs because when they hold Holcim and Holcim splits in two parts, and one part is the American part, and it still notes on the Swiss stock market, then the ETFs can hold it in their portfolio, so they don't have to sell it immediately because it's only noted on the New York Stock Exchange, for example. So in that regard, they should communicate clearly about how the split is going to go, because that is, yeah, announcing the split had a positive influence on the price evolution of the stock. But now the uncertainty about how it's going to happen, it's weighing a bit on the price right now. Then we have one of the technology sector, so a German stock, Infineon Technologies. You have a price right now of 30.76 euros, and as you can see, with the dot-com crash, it was around 75. It dropped hugely, and here it was even around 35 cents. So you could pick it up really cheaply at that time, but not a lot of people were doing it. Although when you see the, how do you say it, the volumes being traded here, a lot of people were picking up Infineon. And with a dividend of 0.35, now you actually have a dividend of 100% of the buying price when you picked it up at the lowest point, which is always nice, of course, when you were a buyer then and you still have it in your portfolio, because that are the two main cases that you need to fulfill when you want to have 100% dividend yield on your buying price. So you have to have bought it then, and you still have to have it in your portfolio. But a dividend right now, in dividend yield right now of 1.13%, so what is actually not that bad for a technology company. An earnings per share of 1.62 euros, so that means a payout ratio of only around 22%. The PE ratio right now just below 19 because it dropped today as well. So it was 30.90 on Thursday, and now it's 30.76. It was up during the day, but after the opening of the USA stock market, all the stocks started to drop, of course, in Europe, because the USA is always directing the direction of the European markets. That's quite annoying, but it's the way it is. The positive points for Infineon, it's well positioned in the market, so it makes semiconductors for electrical vehicles and energy power solutions, so that's really nice, and it has really great solutions, really great semiconductors for it. They have strong financial numbers, and they are working with high margins for the semiconductor market. The negative points are that the semiconductor market is really volatile, and especially the one for electrical vehicles is uncertain right now. ASML, they put out their numbers one day too early by accident, and the stock drops with more than 20%. The next 2 days later, you have TSMC that makes open their results, and they say AI is still booming, so artificial intelligence is still booming, and all the semiconductors, the chip producers are shooting up again. So it's really incredible how fast it's going. It's going up with 8-10%, and then it's going down 8-10%. It's incredible. So highly volatile market. So when you can deal with it, Infineon technology is something for you. When you can't deal with it, with those high fluctuations, stay away from it. Don't touch it. And yeah, the market, it has many players and it's really specialized. So you have to have well-educated people. And when you have the well-educated people, you can have the right chips, the right semiconductors, and then you can ask the high margins, just like Nvidia right now. They have the right chips and they really are raking in the profits right now. But it can be that one of the other players suddenly comes with the absolute bomb of a chip, and then you are out. So it's a roller coaster, the semiconductor market. So we can go to the bank sector with ING, and ING, as we say in Dutch. It's a really nice bank. My uncle works for ING. He's a director of some banks in Belgium. So I really know ING well. I was a client of ING as well before I moved to Switzerland. The dividend of 1.11 euros means that you have almost a dividend yield of 7%. A few weeks ago you had more than 7%, but yeah, the stock price keeps rising. The earnings per share was 2.02 euros and the payout ratio is then just below 60%, so I like to see that. The PE ratio is still really low with 7.91. And yeah, ING, it's a really great bank. It has a good mix across retail and wholesale banking. It has a strong digital focus, so their digital platform is really great, which is a positive plus, of course, because you can reduce the costs a lot compared to other banks. And negative points, yeah, it is a bank, so it's in the banking sector. So I always say it's better to buy an ETF that focuses on banks. Then you are already diversified over the bank sector, and then you still have to buy other ETFs to diversify against being only in the bank sector, of course, but that's another thing. It's interest rate sensitive, and you have rules for the bank solvability, and that's always negative for the banks. But I think it's a really good thing for the normal people, because when you know what happened in 2008, and actually that was what happened in 1930, 1929 as well, with the Great Depression, the banks overplayed their hand. And now with the solvability rules that they gave the banks, they are not happy, the banks, of course, but it's more safe for us. So in that regard, it's a good thing. Then we have a Swiss stock, Logitech, another technology company. I don't have that many technology companies in the list of 20 stocks, but this definitely needed to be in it. All my keyboards and my mouse and my computer mouse and everything, it's all from Logitech. I really like how they produce everything. It's really it's I like working with it. Yeah, their 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 keyboards are really nice to type with, and especially their numbers, they type really well. Their dividend is 1.16 Swiss francs, and by by having 1.16 Swiss francs, it's 1.54% in dividend yield. Their earnings per share is 3.80, so a payout ratio of around 30%, and that's what they want to aim for in the future as well. Always a payout ratio around 30%. So that's really nice that we know that. The PE ratio is 20.03, so a bit too high for me right now. And I think they are going to come down a bit in the next 3-4 months. I can be mistaken, of course, because I like Logitech and they are doing great. They focus a lot on innovation, and recently they they said something about the new keyboards, so the new keys that they have for the keyboards. So gamers are going to be really happy in from for Logitech. So they are, yeah, they have a wide range of products. They have a lot of products for gamers as well, and that's what I like to see. And they keep innovating, and that's really important. On the other hand, they need to put a lot of money into R&D to keep putting out those new products. You have the currency problem, of course, because you are a Swiss company and you are producing for all over the world. So then the currency problems are always there. And it's a highly competitive business. So you can have a Japanese or a Chinese firm coming out with a new keyboard that is the bomb, and yeah, all the players that need to change their keyboard, they are going to switch to those keyboards and not their normal keyboards that they bought from Logitech before. So that's always a tough business to be in, but Logitech is really keeping up, and I hope that they continue to do that in the future as well. Then we go to another Swiss company, Nestlé. That's a world leader, of course, in the packaged foods. And right now, 85.98, it shot up 2 days ago or 1 day ago. After yesterday morning, it shot up. First, it was going down during the call, and after the call, it really picked up quite fast. So it went from 81 to 86 in no time, and now, yeah, it ended the day at 85.98 with a dividend of 3 Swiss francs. It has a dividend yield of 3.5%. The earnings per share is 4.27 Swiss francs, so the payout ratio is 70%, a bit too high to my liking. But yeah, in the food industry, it's not abnormal to have a bit of a higher payout ratio. The PE ratio right now, because of the 3 Swiss francs that it shot up, it's now above 20 again. It was around 19.30, 19.4, and I was hoping to pick it up below 19, but now I think I have to wait a little bit longer. The positive points, it is a global leader, and I think it's going to remain the global leader. It is a company with strong brands, and they continue doing high investments in sustainability. And yeah, in the negative points, they have a negative image, and that is hard to lose, even though they put a lot of money into research towards sustainability. For some people, it is never enough, and they use the internet fora and stuff to yell at Nestle, and people are following them instead of really researching in what Nestle is actually doing. But that's often the case. So as an investor, you have to deal with that. But as you can see, yeah, the price, it's going down and down and down, and it really doesn't deserve to be this low. But yeah, that's the stock market. And me, on the other hand, I hope that it drops around 80 so that I can pick it up more cheaply. But I really would like to own 2 stocks of Nestle in the future. Then we have PSP Swiss Property. It's a real estate company. So right now 125.70. So if I buy one stock of this, I still have 75 Swiss francs left over for the month, which would be a good thing because then the month afterwards I can buy a few stocks more of something else. But the dividend is 3.85 Swiss francs with a dividend yield of just above 3%, and the earnings per share is 6.25 Swiss francs. So payout ratio for a real estate company actually not that high, 61.6%. So that's really nice for a retail real estate company. You have the PE ratio of 20.11, so a bit too high to my liking, but that's again because, yeah, since the beginning of the year, the price is going up and up and up. So around 100, it was really nice to pick up the stock, but yeah, at that time I was only buying ETFs, of course, so I can't complain about that. And the positive points, this firm has a really great management team. They focus on prime locations in Switzerland, and they have a really strong portfolio of real estate in their portfolio. They pay out consistent dividends, and the only negative point that I can give is that they are only present in Switzerland. And for the rest, yeah, it's a competitive business, but their portfolio is so strong that I don't think that they have to panic. And if they maintain their portfolio and do all the work that needs to be done to their locations, I think they are going to be profitable for the next 30-50 years. They are really great. So this one, if it drops, I'm definitely going to pick up PSP Swiss Property. Then Shell, the stock from the Amsterdam Stock Exchange, that is actually a stock from the UK, and you can see it in the ISIN code GB, and it's a oil and gas integrated company that is in the energy sector. So it has a price of 30.73 euros right now. It pays out 1.23 euros in dividend. And on the Amsterdam Stock Exchange, it is truly in euros. A lot of people don't like it, but it's the same with Unilever. So they also pay out in euros on the Amsterdam Stock Exchange. And for European investors that have their money in euros, that's of course really great. And I like it as well because I hoped that I could be able to include Unilever from the Amsterdam Stock Exchange as well, but unfortunately, yeah, Yuh doesn't allow me to buy it on the Amsterdam Stock Exchange. I hope they change that in the future, but yeah, I'm only a small fish, so I don't think they care that much. The dividend yield, it's 3.98%, so almost 4%. The earnings per share is 2.60 euros, and the payout ratio thus is less than 50%, which is really nice. And the PE ratio is really low as well, below 12. So definitely one that I have on my radar to pick up rather soon than late. And yeah, positive points. It is a global company. It has a really strong cash flow, just like DHL. I like seeing strong cash flows in companies. They have a diversified portfolio, not only upstream but also downstream in their business. And they focus on renewable energy as well because they want to be emission neutral, which is really great. And on the other hand, it costs a lot of money to do that, of course. But when they achieve it, it will be, yeah, it will be phenomenal. So I'm rooting for them. And yeah, crude oil and gas, they are highly unpredictable businesses, and they are influenced by a lot of factors. When Trump gives a rally, and the people get enthusiastic about Trump becoming president, the price changes. Then there is Iran that drops a few bombs on Israel, and up the prices go up, and then Israel says, yeah, but we are not going to retaliate to Iran and attack their oil stuff. So then the price goes down again. It's unbelievable. It's also really volatile, just like the semiconductor sector. So if you can't deal with it, don't buy it. And then maybe a less sexy company, Siemens, but it's a it's a yeah, a huge company. If you invested in it all already 25 years ago, now you have 3 or 4 or 5 companies in your portfolio from it, because they split off a lot of other things already, and still they are a huge firm. Their price is 185, and if you look at it since 2003, the price is actually only going up. Yeah, in 2008, of course, with the financial crisis, the stock went down again. But yeah, it's incredible how the Siemens is shut up. The dividend is 4.70 euros. The dividend yield was 2.55%, and the earnings per share is 9.97. So if you think about it, it's a payout ratio of below 50%, which is really great for such a great company. And the PE ratio is just above 18. So it needs to come down a bit for me. This one needs to be around 17 in order to be attractive for me to pick it up. And yeah, it has a lot of positive points. They definitely have a moat, because when companies are working with Siemens and they want to replace the machines that are how do you say it? The machines that are driven with technology from Siemens, they have to go back to Siemens, because yeah, they make it so complicated, maybe too complicated, and some companies are actually complaining about it as well. But on the other hand, when companies are complaining about a company, you know that that company has a moat. A lot of companies are complaining about IBM as well, and they have a huge moat as well. So every time when you hear something negative, you have to keep in the back of your head that maybe it's a positive thing for an investor. And they really focus on dividends as well. So they have a progressive dividend policy, and they give out cash to their investors, and they also do buybacks. So that's also really nice as an investor into Siemens. Then you have negative points. So they still are really big, even after detaching all the other firms that they used to have in their own company. And sometimes when you call them, it can take a long time before they react. And when they come over, they didn't listen that well, so they didn't bring along the part that you needed, and then they have to go back, they have to go fetch it. And yeah, it costs a lot of money to have the technicians of Siemens come over, and sometimes that's a huge burn. And then you always have to wonder whether or not the moat is going to remain there, because yeah, it's a competitive business, and when people are complaining more and more and more, then the moat is in danger as well, because other companies can come in and steal away their business. But so far, I haven't seen it happen that often. So in 99% of the cases, everything from Siemens is replaced by things from Siemens. So in that regard, I think the moat is definitely still there. Then another one that is in our portfolio already, Swatch Group. I already said a lot about Swatch. So dividend is 6.50 Swiss francs with a dividend yield of almost 4% and earnings per share of 10. So a little bit over 60% in the payout ratio. Excuse me for that. But the PE ratio still below 18. So for me, yeah, when I picked it up, it was definitely a good deal for me in my eyes. And I like watches. I like Swatch because they have strong brands and they have a really nice breadth across the whole playing field for customers. So they have entry level up to really luxurious watches. So when you watch Omega and Breguet, that are really nice watches, and a lot of people are really down speaking Omega and Breguet, but those watches are really top notch, and they are produced completely here in Switzerland, which is something that Nick Hayek, the manager, is the CEO, is really proud of, and they are employing 17,000 Swiss people in Switzerland, which is also enormous. That's then maybe also a negative point because they are maintaining their production capacity in Switzerland. They also put a lot of money towards maintaining the equipment to do the production. So that's why their earnings per share was a bit lower than foreseen actually. But yeah, the main problem right now is China, of course. But yeah, the price, it shot up the in the past few days. You can't hardly you can't actually see it in this graph because it's such a long time frame. But if I took the past 4 weeks, you can definitely see a peak after China announced their intentions to have how do you say it, to influence their economy in a positive way, so to put money to pour money into their economy, but they haven't said yet how they are going to do it, so how big the support is going to be. And that's why now, yeah, the past week it's going up and down like a yo-yo. And yeah, the Hayek family is picking up a lot of shares, and then the news came that maybe they are going to take it off of the stock market, but they need a lot of money to do that, and normally they shouldn't have it. So I hope that it remains on the stock market because I really like Swatch. I like Nick Hayek as well. I think he focuses on the right thing. He focuses on the brands. He focuses on the stock. On the stock, yeah, I mean the stock, the lagerbestand. How do you say it in English? So he has a lot of diamonds. He has a lot of gold in stock, so that he can keep producing the stuff that he needs to produce. They also have a lot of watches already made in order when China picks up again, that they can immediately ship the stock to there, so that it goes away. And on the other hand, he speaks a lot about not caring about the investors, and a lot of shorters are of course profiting from that and trading the stock down, because this this uh, this drop this drop this drop, it's completely due to the shorters that play with the Swatch stock. So that's a thing that you need to be aware of when you trade in when you invest into Swatch Group, that you have a lot of people that try to short the stock and make a profit from that. Then we have Swiss Re, that's a reinsurance company, and it's a really great company. It has right now it's 116.80 Swiss francs. It has a dividend of 6.19 Swiss francs, and which means it's a dividend yield of 5.30%. The earnings per share is 10 Swiss francs. In fact, just the same as Swatch that also had 10 Swiss francs. So the dividend, the payout ratio is 61.90%, and the PE ratio is 11.68 right now. So still interesting to buy, but I think I'm going to buy AXA first. Although the solvency ratio of this one is 2.74%, so not 227% like AXA. So actually the solvency ratio is way better, but it is very sensitive to natural disasters, and with the hurricane of that was announced a few days ago in America, the stock went down quite fast. And after the hurricane passed, and it wasn't that big of a deal. Okay, it was a big deal for sure. I don't want to upset some people, but it was way less than foreseen by a lot of people. So in that regard, it was a good thing, but it's still a bad thing, of course, for all the people that lost their houses and had a lot of damage because of the hurricane. So I don't want to, yeah, that's always a difficult thing to talk about such stuff. So, but if you are invested into a reinsurance company or an insurance company, you know that natural disasters are always going to play a part. Definitely now here in Europe as well with the floods, a lot of rain now in the south of France as well again. So it's getting worse and worse and worse with the global warming that for some people isn't happening, but you can see the natural disasters increasing day by day, so you can't go around it anymore. And the insurance business is of course a highly competitive business. The companies are always trying to come up with a policy that is more interesting to you, so that you have to pay a little bit less, but then they left out some stuff in the, or they put something in the small letters that you haven't read, and then when you have damage, they say, yeah, but in the small letters there it is said that when that happens, we don't have to pay anything. So they strike up the money and they don't pay out the damage. That's a bad thing for people like you and me. But on the other hand, yeah, if you want to have high dividend yields, banks, they are, yeah, they aren't, how do you say it? They aren't charity institutions as well. They make money from your money, and they make money from you as well. And with insurance companies, it's just the same thing. And then the last of the 20 stocks, it's Volkswagen. I had fun with putting all the brands here that they have. But I think it's really important that you also take notice that you have Volkswagen Financial Services, because that is a really important thing. They make a lot of money with Volkswagen Financial Services as well. So don't forget about that. I put here another ticker as well. With Swatch, you can also you also saw another ticker. That's a cheaper stock. The in by with Swatch, but there you don't have voting rights. Or no, you have 10 times more voting rights with that one. So in that regard, the Hayek family is buying a lot of UHRN stocks because it gives them more voting rights. But in this case, VOW3.de, it's always noting around 4 euros cheaper than the VOW.de stock. So here the price is 95.90 euros, but you can also buy the other ticker, which doesn't have voting rights. So the VOW.de, that one has voting rights in the General Assembly, but the other one doesn't have it. And in that way, it is cheaper, but which means that when you are receiving your dividend, you have a higher dividend yield. So for this one, it's 9.53%. If you have it for 92 or 91 euros right now, I think it's 3 euros that it's not cheaper. So for 3 euros cheaper, you can augment your dividend yield to 9.80%. But in the Yuh portfolio, I have the stock that gives me the voting rights because I want to decide what is going on in the company that I invest in as well. The earnings per share is 29.76, so that's incredible. You have a payout ratio of only 30% and a PE ratio of 3.22. That's why I picked up Volkswagen without even thinking about it, although the auto manufacturer business, it's a really, really big mess. It's, yeah, it has a lot of competition from Chinese car manufacturers right now because they can really produce things cheaply. Tesla is even producing their Teslas in China for a really low cost and then shipping it out to Europe and America and selling the cars there for huge margins. And people aren't complaining about that, but people are complaining to Volkswagen because they want to reorganize and maybe fire people in Germany. Although they do the same thing at the Audi factory in Belgium, there those people are complaining, but not in the same way as people are complaining in Germany. So it's always difficult when companies are in need of a reorganization, but it's a bit more difficult because a lot of important shareholders have a huge stake in maintaining the employment where it is. So, of course, it's a global presence, so you have the high production costs. If they were able to produce in China as well, so close down maybe a German factory, which I hope that they don't do. Don't put those words in my mouth, but if they open a factory in China and they produce the cars there, it's way cheaper. So it's just a reality, and the cars that are coming in from China, they are produced there, so they just have a lower production cost, and that is eating away market share from Volkswagen. And on the other hand, yeah, they focused on electrical vehicles, but their range wasn't that great, so people weren't that interested in their cars. And on the other hand, they were smaller, so people with 3 kids, they had to go to a caddy or yeah, an ID bus, and not a lot of people like those kind of cars because they are not that pretty actually. So that's another thing, of course. And car business, it's a highly competitive business. So yeah, difficult stock Volkswagen. A lot of problems lying ahead, but on the other hand, they keep selling cars because yeah, Volkswagen cars, they are great. They have great engines. They are produced well, and with a PE ratio of 3.22, you can't go wrong. So for me, Volkswagen, definitely a buy. I already bought it, so if it goes down further, because now I'm in the red on Volkswagen, but I don't care that much. I know that in the long run I will make a profit for sure. It's going to go up to 150, 175 again in the near future or in the far future. I don't really care. I like Volkswagen and that's why I own it. And then I'm going to name 7 or 8 more stocks. I don't remember exactly how many there were, but unfortunately, EU restrictions prevent me from investing in Raiffeisen. You also have EVN from Austria. So two from Austria. You can't buy those stocks in Switzerland on the Yuh-platform. I don't understand because it's a country just beside us and we can't buy Raiffeisen and EVN. It's hard to believe, but it's you. Then another stock from Belgium that I actually would be really interested in buying. It's Akkermans and Van Haren. It's a really great company, really underestimated by a lot of investors, but it's 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 a stock that when you live in Belgium, you should definitely take a look at it and consider putting it into your portfolio. Then you have Ahold Delhaize, great company as well. Nice shops to go and buy your groceries. Then you have Unilever, as I already said. You can buy it from the UK, but not on the Amsterdam Stock Exchange. And I want to buy it on the Amsterdam Stock Exchange because there it's in euro. And then another one from the Amsterdam Stock Exchange, it's Prosus. That is a really great company, just like Adyen. Okay, Adyen, it's way too highly priced right now, but Prosus, it's 50% undervalued. And yeah, I can't buy it on you because you can't find it to put in an order. And then finally, it's Indra Sistemas. When I was talking about the Spanish stocks, I already named it as one of the best stocks on the Spanish stock market. And unfortunately, Zara you can buy. So I'm really disappointed that I can't buy Indra Sistemas, but it's the way it is, and it's 8 stocks that I have here on my list. And from the moment that one of those 8 stocks come available on the Yuh-platform, you can bet that I will announce that I replace one of the 20 stocks that I named before with one of the stocks that I have here on this list. And with that being said, I thank you for watching to this one and see you the next time on my YouTube channel. Bye.